Hello everyone, Felipe here. So as you know, I'm here to keep you up to date with current market news, teachings, and everything tech. So what I'm going to be talking about in this video is basically what I'm seeing in the market, right? Market sentiment and so forth, and developments that have occurred recently, which it kind of revolves around the Federal Reserve, right? Because Jerome Powell spoke a couple of days ago, and he sounded extremely dovish, which is a fancy term for saying that they are thinking, or they're saying that all the data they're getting, economic data, makes them confidence that they can now begin decreasing interest rates, right? So based off of his terminology and what he said on his speech, he sounded very dovish, meaning that it's very likely that the Federal Reserve is going to drop interest rates in September. How this affects the market is in a couple of ways. Interesting enough, we've seen one of the biggest rate hikes in a long time over the last couple of years, and monetary policy acts very slowly. It's not felt in the economy or in the markets immediately, right? It takes time to settle in. So I feel like we haven't really felt a shock of the increase in rates, just because the fact that monetary policy just acts very slowly, right? So with that being said, they were saying, hey, we're confident in the data we're getting, and based off of that data and viewing future developments or incoming data is going to tell them whether or not they're going to continue decreasing interest rates, the federal fund rate, right? So, but it sounds like pretty much he's going to drop rates in September. So some things I've been watching is specifically the VIX volatility index, because of the crazy explosion that happened August 5th. And supposedly the reason for that explosion, or the speculation in the markets, is because it was due to the yen carry trade. Again, it's all speculation at the end of the day, because no one really knows what causes these kinds of things. They just look at, what might be potentially the source. So the yen carry trade is just basically borrowing Japanese yen, which is cheaper, right? And investing overseas, for example, in the United States. You're borrowing cheaper yen at a lower interest rate, and you're investing in the United States or internationally, earning more interest rate, right? The danger there is, if the yen increases in value, you're now holding that loan that it has now increased and costs you more, which can potentially cause a margin calls and so forth, which supposedly is what caused the market sell-off in August 5th that happened in the Nikkei and the S&P 500, NASDAQ, and so forth. So I have VIX futures here, and I kind of just like looking at them on a monthly basis on all the contracts upcoming to see what the price looks like. Of course, volatility index is volatile, right? That's the name of it. But here, from what I'm seeing or what I've been observing, is that a volume has been upticking in the VIX index futures, while the front month and future months of the contract, for example, October, all the way up to possibly next year, the price seems to be increasing, right? So is this possibly saying that the volatility index is going up? And if so, that is not good for the markets, because volatility index is just basically people buying option puts where they're hedging their market exposure, right? Because if the market goes down, VIX spikes up, basically means people are buying insurance on their portfolios, right? So here you can kind of see the insane explosion the VIX had on August 5th. And again, supposedly that was because of the Japanese yen carry trade issue. That's all up for speculation. In reality, who knows what happens in the markets. But yeah, it popped to crash levels, and that's unusual for the volatility index to hike that much so quickly. And it's kind of crazy stuff to see, right? That typically only happens in market crashes or panics and so forth. So with the Fed basically coming out and sounding very dovish and saying that they are going to be, there's a high probability of them dropping interest rates on in September's Federal Reserve meeting. Certain strategies might potentially arise, right? Opportunities. For example, one of them that I'm seeing is interest rate sensitive investments, right? Because interest rate sensitive investments can shift depending on where interest rates are. And what I'm specifically looking at is zero coupon bonds, right? Because they're the most interest sensitive vehicle in the markets. Zero coupon bonds or treasury strips. The word strip just means they strip the interest that U.S. Treasuries typically pay on a semi-annual basis. In this case, strips don't pay any interest, right? They're sold at a discount and they appreciate as they come towards maturity. Meaning that appreciation of that zero coupon bond is the interest you gain on the investment, right? However, zero coupon bonds mean that they don't pay any interest and they can be long-term vehicles. They're extremely sensitive to interest rates. When interest rates drop, zero coupon bonds appreciate a lot quicker. In an approximation of for every 1 point decrease in the federal fund rate, zero coupon bonds can jump up to 10%. So a 2-point a 2-point decrease in the federal fund rate can mean potentially a 20% increase in zero coupon bonds, because as interest rates drop, these vehicles appreciate. So it's something interesting I'm looking at as a potential opportunity, right? Which doesn't happen all the time, right? So here I have an ETF called ZROZ. It basically invests in zero coupon bonds or strips of at least 25 years remaining until maturity. So here it kind of just tells you, as such, this product would be very sensitive to the changes in interest rates movements, performing very well when rates drop, but likely struggling if rates begin to climb, because treasuries are interest rate sensitive, right? As interest rates rise, they drop. As interest rates drop, they appreciate. Another option here is potentially the TLT, which is just basically long-term treasuries. And it's very liquid, right? So these are some ideas I'm looking at as the Fed potentially goes towards a stance of decreasing interest rates. If the economic data keeps coming in where they feel that inflation is no longer a problem. So certain things that also arise is, for example, I've been noticing that, people like Michael Burry and George Soros and so forth, they've been dumping a lot of money in China, and that's a kind of a market that I've been researching and studying for a while and trying to understand, because it seems like in terms of valuation, if you're a value investor, which it just basically means you're looking for paying less for what you get. China has pretty much gone over the last couple of years through a pretty steep declines in the markets, right? I think the Hang Seng has dropped something along the lines of a crazy 40%. But a specifically industry in China that really attracts me is the tech industry, because they have companies that are comparable to the United States tech industry, Amazon, Google, so forth. They have the Alibaba and all these other tech companies that are pretty much selling at attractive valuations. And as interest rates drop, supposedly, according to the Federal Reserve, if they continue with their dovish stance, this basically means the strength of the US dollar as a currency is going to decline, right? And that being said, this is bullish or good news for international markets because those international markets have their own specific currencies, right? In the case of China, they have the RMB, which as the strength of the dollar declines, the value of the RMB should increase, right, in comparison to the United States dollar, right? And this is bullish for their markets. Specifically, the market that I'm interested in China is the tech market, which there's a lot of great ETFs where you can take advantage, such as KWEB. KWEB is one that I really like, which I'll just put over here quickly. But you can kind of see here, this is a pretty good ETF. So it's been hammered over the last couple of years. This is pretty much just completely hammered. Whereas in 2021, this thing was about $100 a share. Now it's around $25 a share. Pretty much near all-time lows, right? So I look at this and I'm like, hey, there's a opportunity here as a potential value investor to get more bang for your buck, because there's a possibility in the future the Chinese industry tech market is going to be worth a lot of money, right? So this ETF has a lot of their big named tech companies to gain that kind of exposure, right? Because it is a lot of risk in terms of just individually investing in a specific stock, which some people do, but you can basically get exposure to their tech market through a basket of stock, right? On another note, basically another thing, I've been kind of looking at the economic data and kind of seeing how things are looking. Here we have the unemployment rate, which is a lagging indicator. By lagging, I mean typically when this thing has increased dramatically, or unemployment, has become a big problem. A lot of people are getting laid off and so forth. So at the worst of the unemployment rate data, pretty much what's happened in the market has already happened, right? Because it lags the actual markets. So, but what I find interesting here is that this thing, looking at it from like a technical point, it seems to be curving to the upside, right? Meaning that it seems to be uptrending. And for the most part, typically, if you look back in the past, when unemployment trends up, it tends to continuously trend up to a certain point, right? So let's look over here. Recently, of course, COVID just was just craziness. You can see the explosion of unemployment rate. It went up to 14.8%. That's nuts. But here, what I'm really paying attention is just seems to be curving to the upside, right? So it's somewhat continuously increasing. Does this mean that we're just going back to how things were before COVID, or does this mean that there is potentially something nasty coming on the other side, right? And like I was saying, monetary policy is painfully slow, at least historically. It takes a long time for it to be felt in the markets and the economy. So that's still there to be watched, right? So one thing I've been watching, because supposedly the whole August 5th craziness with the VIX and the markets declining had occurred due to the speculation. Word is that it was the Japanese yen carry trade, right? So one thing I was looking at in terms of their statistics is what their imports and exports look like. Because if a country is exporting more than they import means they're bringing in, they're importing things in. Exporting means they're selling things out of the country, right? So it seems that they've been importing more than they have been exporting. So when a country imports more, when a country exports more, it's typically good for the currency, right? That puts upward pressure in the country's currency, meaning their currency strengthens because they're selling more things out of the country. But in this case, at least that side of it seems that imports have been higher than exports. So the only thing that could potentially affect the Japanese yen now, or the pressure for it to go up in strength, is that if the Federal Reserve drops interest rates, the dollar again loses value, US dollar, and then this is bullish for international markets and international currencies, the yen being one of them, right? So that is some things I've been looking at, and I kind of wanted to run by you guys. With that being said, I'm going to leave you guys with a market quote. And then this is interesting because it kind of relates to what's going on with the Japanese yen. So with the knowledge that there is always a chance for a big move, it's hard to justify risking dollars to make a dime. So the whole joke about the Japanese carry yen is you're picking up pennies in front of a steamroller. So that quote, interesting enough, kind of matches that. So yeah, with that being said, thank you guys for listening to me. And if provided some valuable information and you'd like to hear more in the future, which I sure will be doing, please tune in, and I'll talk to you guys, and I see you on the next one. Have a good one.